So, one of the first, at least modern day subscription clubs, and these are these companies that want you to sign up to get the same type of product on a regular basis. And there are such a flock of them, and they've mostly been advertising in the subway because I see them on the way down to FIT quite often. And you know the ones I'm talking about. But Dollar Shave Club is one of the first. They're pretty interesting outfit. Let me just give you a little bit about their history. This is from Wikipedia. Founded by these two guys, began operations in 2011. They thought razor blades are too expensive. They got money from an incubator called Science Inc. So this is an investment company that specializes in very, very, very baby startups that are just starting. That's why they call them an incubator. They're they're getting small babies going. Launched their website in April 2011. Okay. And here's a bunch of other stuff. This is in terms of their finances. So after the incubator, which I'm sure paid for them to advertise, uh, they got different what are called rounds of financing. So they went to some very famous investors here. Kleiner Perkins Caulfield's very famous. Andreessen Horowitz, very famous. Shasta Ventures, probably famous. I don't really know about them. They got another $1 million from these folks to keep expanding. And by the way, each one of these steps, the investors are going to be given shares, stock in this company. And then the same group of these three investors gave them another 9.8 million in 2012. So in March they get a million. In October they get another 9.8 million. My guess is what they're spending money on is advertising to get new customers. And my guess is also that the reason they're getting all this money is that because the advertising is A, working, it's bringing in new customers, and B, the new customers that are signing up for to be sent on a repeating basis the product. So that's built-in loyalty, right? That's why these are, I'm including this discussion in our discussion of loyalty. What they're finding is that they did not have a big drop-off rate in people who signed up to get new razor blades every month. And so this is working. This is an engine that when you put gas in it, runs and goes somewhere. So they're like, well, let's give it some more gas. So the same three investors, joined by another one called Venrock, which I also haven't heard of, come back and put almost 10 million in. Then a year later, there's another 12 million with Venrock and some other investors also getting stock in the company. And then they announced they're expanding their product line. I know, for example, they have shaving cream. They already had shaving cream, but they had a lot of other things for men. So the same customers. How do we sell more things to the same customers? All right, this is what loyalty is all about. I mean, why does Amazon Prime? They want you to buy products from the stores. They want you to subscribe to or to get the video. They want you to rent videos. They want you to buy books. They want you to buy this. Groceries now, they've got Fresh Direct. They want you to buy Fresh Direct. So the idea is to cross-sell current customers, loyal customers. If they like you that much, what else can you sell them? This is a classic example of not only building loyalty but monetizing, making money from more money from the customers. So all this is working. So then in 2015 they get another $75 million. Okay. And then guess what? They have an option. They can go public and do an initial public offering and sell shares to the public to raise even more money. And now all of a sudden the stock I own as a private investor, I have a certain number of shares. I can sell those myself and cash out. The other option, other than an IPO, is to just sell the company to another company. And this way, everyone who invested, starting with Science Inc., the incubator, Kleiner Perkins, all of them, plus the owners of the company have given themselves a lot of shares in the company, and the early employees probably have shares in the company. Everybody sells, a lot more money is raised because July 19th, 2016, Dollar Shave Club was bought by Unilever, one of the largest packaged goods companies in the world. It's a competitor of Procter & Gamble, based in Europe, for $1 billion. Interesting success story there. Good products, good knowledge of the customer, great example of loyalty building. Now, before we leave our topic of offers, and we've talked about trial offers, we talked about loyalty offers, just continuity offers where, like with Subway sandwiches, if I buy 12 Subway sandwiches, I have my little card that gets stamped. I can go back and get the 13 sandwich free. That's a typical continuity, but the smarter ones then, the more sophisticated loyalty programs add tiers or levels with different privileges assigned to each level, especially recognizing the likely most valuable customer, giving them the highest level of privileges, special phone numbers, etc. And then again, we talk about these interesting subscription programs, which are just loyalty programs from the get-go. But remember always that the key performance indicator for all these offers is not the initial transaction. It is what Dollar Shave Club saw. Am I getting loyal customers with the ads, with the trial offers? Is it bringing me the types of people that match the profile of my most valuable customers from my database? If I'm an existing company, I can go in and look at my database, see what the characteristics are of the people that are most profitable. That's who I want to attract with my advertising. That's who I want to get with my trial offers. And the success and whether one offer is better than another in testing has to be based on whether I'm getting people who are likely to have a high lifetime value. What is the calculation for lifetime value? That will be asked in the quiz at the end of this part. But again, direct is testing. Offers can be tested, just like the scientist is testing. Testing, I usually just change one variable in my email, and the variable can be the offer. It can be how I express the discount. It could be a percentage versus a straight dollar amount, which pulls more people, which has more transactions, but more importantly, which attracts a higher value, higher lifetime value customer. And again, we've looked at this in our database lecture. Remember, it's a relational database with an operational database linked to the marketing database via the customer identification number. But the point here is that every time I send communications with an offer to a different segment, I am going to hold back a chunk of the mailing and send a different offer. And I'm going to see which outperforms. And that's the one I'm going to expand. That's how the testing works. Every time I do something with direct marketing, because I can measure it, I'm going to test and try to make it better and better each time. So we've now talked about, tell them what you told them. We defined an offer, something to make you move. It's different from an offering, which is everything I'm putting out there, the product, the price, etc. The delivery. The offer is specifically designed to get you to do something, right? There are trial offers that kick you in the butt and get you to try and jump off, do the bungee jump. There are loyalty offers, which are different ways of doing it, but they're all geared to get you to be a loyal customer. Remembering, however, that the most important factors for loyalty aren't the offers. That's the icing on the cake. Most important are having a good product and good service. Okay, and we talked about the importance of testing. So what's due? 3 things you learned, 1 thing or 2 things muddy, or if nothing's muddy, you can say so. Read the chapter on offers. And I'm probably going to ask you to get ahead. I'm probably going to change this and ask you to read about accountability so that you do that before the next class. So don't be surprised. So when you look at the folder for this week, you're going to read about offers in the textbook and also start to read about accountability. Your teams should be continuing to work on the direct mail piece. You should have chosen your brand based on certain criteria. You should have, by now, you should be looking at the advertising and the communications for the brand you've chosen and reverse engineering the copy strategy, the Tabasco. Now, you can make up your own offer for the mailing, but remember, the mailing is for new customers. The 5 pieces are to get new customers. And you figure out whatever offer you want. You don't have to do an existing offer. You can, if you want, use an existing offer, but you don't have to. So the letter, everything you write and put together, the brochure has to be based on the Tabasco that you've already reverse engineered for the company. Recorded presentations are going to be due by the 13th. That's the Thursday. And so you're going to file a team meeting report after your meeting this week. Okay, so that's really it. I really want you to focus on working on the direct mail project. I'm not giving other homework. And that is what's wrong here. So this is what we talked about. We didn't really talk about LTV. I don't know why I had that in there. Oh my goodness. We talked about offers and about what's due. Oh, this is going to be in your questionnaire after this piece. We never talked about sweepstakes, so think about a sweep. What is a sweepstakes? What does it get from the consumer? What does it get the consumer to do? How does it fit the purchase funnel? It's going to be a little essay you're going to work on, and it will be in the quiz at the end of this part. Thus endeth our discussion of offers.